Hello, everybody. Welcome to the Crypto Hipsters podcast, where I interview founders and co-founders, entrepreneurs and artists, executives and stay-at-home hipsters in crypto and blockchain around the world. And I have an amazing podcast for you today. Let's get to it. Today, it's an honor and a privilege to introduce a guest to you in the U.S. from the great city of Chicago, Michael Creadon, who's the Managing Director of Inveniam. Welcome to the show.
Thank you, Jamil. It's great to be here. I'm a big fan of yours too, and can't wait to get started and do this.
Great, awesome. First question to kick things off. What is your background, and how does it relate to what you do now at Inveniam?
Absolutely. So most of my career was spent trading interest rates at Chicago Board of Trade and CME. So I started the firm there, was head of risk, and managed a lot of what are called proprietary traders. So a proprietary trading firm is different than a hedge fund in that you don't take outside investor capital, it's just all the firm's capital. So it made my life easier. It's less regulatory burdens. So you don't have to shake people down for money, but loved the job, loved what I did. And I was involved in, capital markets every day for 20, 25 years. Before that, I was a journalist. I worked a time in Bloomberg, and I love to write, and I continue to write today very, very often on LinkedIn. As it pertains to Inveniam, one thing I knew almost nothing about or hadn't really thought about was the difference between public markets and private markets. Public markets are stock markets, futures and options, things that trade on exchanges, commodities, things that trade frequently. Private market assets are things such as commercial real estate, private equity, private credit, infrastructure, mining, that are held by private investors. They could be institutions like endowments, pensions, high net worth family offices, and the like. And the challenge for private market assets is the data is not nearly as complete, for lack of a better word, than it is in public markets. So there's a lot of inefficiencies. And we think in Inveniam that better data is the key to unlocking a lot of value on those assets. And just to give you some comparisons, private markets are 5 to 10 times bigger than public markets. So when you consider the size of the problem that we're trying to disrupt, it's a huge opportunity for us, and we think for our clients and our stakeholders at Inveniam if we can get this right.
Great. Speaking of private markets, a lot of them you would think are siloed. So when I'm on Twitter talking about posting about crypto, a lot of people on crypto are only looking at the crypto market, and the fact is that a lot of these markets are intertwined, interwoven. What happens in the bond market or equity market will impact the crypto market. So I wanted to ask you, you said you traded bonds and commodities in private markets for 20 years. So you have a unique perspective, probably one of the most unique perspectives I've seen on the fixed income markets and also on the Federal Reserve's view on global markets. How do you see the global bond market behavior trending in 2021? And how will this market environment impact crypto?
Wow, it's a great question. I would, again, let's start with the bond market first. I mean, let me just tell you that after Lehman Brothers, which I know you were very active, I'd love to hear you talk about your involvement with where you were working back then. I believe it was AIG. But after Lehman Brothers and that shock in 2008 and the recovery of 2009, the Fed pinned down rates at zero, what was known as ZIRP, zero interest rate policy. Well, we didn't know it would be forever. But in 2010, 2011, 2012, as a bond trader, you're sitting there saying, when is the action going to start? When are interest rates going to start to move again and float? And the reality is it never happened, more or less. And because the Fed just was committed to low interest rates, because they were committed to job growth, and they just are messianic about it. We got to get the unemployment rate down, and until we do, and because inflation is not an issue, we're just going to put the pedal to the metal and keep rates low. And that carried on all the way till coronavirus popped up. And then there was an acceleration even further downward in rates. So the point is, the Fed is very, very patient. The Fed is extremely committed to their goals. And in that context, I don't think the Fed's going to get shaken out of this anytime soon, even if the growth numbers go up. But you have to remember about the bond market that there's players that need yield. It may not be me and they may not be you, but the largest insurance companies in the world, they need a fixed income on their balance sheet. And so when you look around the world for global yield, if you look at Europe, they still have trillions of dollars, I believe, in negative interest rates, trillions. So nobody's going to want to buy the German 10-year at negative 30 basis points when they can have the 10-year in the US at 170 basis points. So anyway, the point is there will be demand for US bonds. I don't know if that means at 170, 220, 240, but it's not going to be 5%. So again, every time you get an uptick in the economy since Lehman, people start talking about 5% 10-year yields and hyperinflation. And so far, that's yet to pan out. That's yet to happen. I'm not saying it can never happen, but I'm just saying if you look back at the data, even since the 70s, we've just never seen a spike in hyperinflation in 40 years in this country. Doesn't mean it'll never happen. But what I'm saying is I think that the 10-year yield in the bond market can find some equilibrium in and around here, stabilize, and then so I mean, if I had to flip a coin, I would say at the end of this year, rates will be lower in this country than higher. But again, shoot me if I'm wrong, but I've seen this movie for 12 years now, and every spring people are talking about higher rates, and at the end of the year, it goes the other way. So I've said enough on that. In terms of the crypto markets, my view is certainly counter to a lot of people's. I just continue to think Bitcoin is a currency. Other people disagree. Other people that know a lot more about it than I do. They talk about the blockchain and all these other things, and that's great. But I see it as a currency, and I think it's becoming a mid-tier currency is how I describe it. The way I look at it is we had a shock, which was coronavirus. The Fed flooded the markets with liquidity, drove down interest rates to, not rational. I shouldn't say not rational, but to very low levels, and they did it for a reason. But now as the economy is coming back online, coronavirus numbers are going down, interest rates are going up. And, but as to where they're going to end at the end of the year, I'm not that worried about it, to be honest with you. I traded fixed income for 20 years. And after Lehman Brothers, people thought rates would spike, once Lehman was kind of over. And quite frankly, they never did. And they never rose dramatically because the Fed stayed committed to easy money policies. And they introduced things like quantitative easing, and they bought back bonds. And the Fed is absolutely messianic. There's no other word for it, about keeping interest rates low. They want interest rates low to create jobs, so long as inflation is not a problem in their eyes. And if that's the formula, the Fed has two mandates: keep inflation low and create jobs. And until there's a problem with inflation in the Fed's view, and until they have, a perfect employment situation, they're going to keep rates low. So, and remember, there's a lot of overseas buyers that need to buy treasuries because they need yield on their balance sheet. These are insurance companies, and they're looking for yield. And if they look in Europe, they're not going to find any attractive yields because rates are still negative there or close to negative. So all I'm saying is the 10-year yield at 175 basis points, there will be buyers. And that doesn't mean it can't go to 2% or 3%. I don't know. But if I had to flip a coin, I think rates will be lower at the end of the year than they are today, because I've seen these markets for many years, and it'll never cease to amaze you how many buyers will show up for treasuries. So we'll see.
And then right now overseas, and even here, there is a phenomenon right now in crypto of DeFi, decentralized finance, and people are chasing some yield. Do you think at a high level that could ever replace the bond market because of the sheer volume of the bond market?
Well, I would say no, but I mean, again, I'm always open to being wrong. I mean, that's the one thing about trading for 20 years. I mean, if you're going to trade that long, you learn humility. And so a lot of times I'll think I'm right, and I find out that I'm wrong. So I would say, like, I'm very positive on DeFi. I think it holds great promise. I need to learn a lot more about it. But like anything new, there will be scammers, and there will be people that are doing things that they don't understand. And I mean, I've been around risk for a long time. You've been around risk for a long time. I mean, even on Wall Street, things blow up all the time because people just can't. It's hard to get all the risks removed. And so I'm very confident that in DeFi, there will be spectacular failures because people haven't thought through it. I mean, just to give a specific example, like I was in the Bitcoin lending space with a company and that, all came from traditional markets, and we use options to hedge off the risk. And we think we could reduce those risks. I think a lot of crypto lending platforms are not hedging their portfolios. I mean, how do I know that? Because they told me that. So that makes me very concerned. I mean, I don't know how else to say it. I think if you see a 50% move in Bitcoin in a day, up or down, then you're going to have margin calls, significant margin calls that won't be kept. It'll be similar to like what happened with GameStop, right? Where all of a sudden you think that can't happen, and then it does happen, and then the people that are exposed get hurt, and the people that put their coins up on those platforms lose their money. That's how things work. So, I mean, because so anyway, having said all that, I think that clearly there's yield in the Bitcoin world in digital assets. I would just do your homework and really make sure that you understand what you're investing in, and you trust the counterparties. I would want to know a lot about their track records, and then look into it. I mean, I have to say, I've been pleasantly surprised that the big Bitcoin lending firms, don't seem to be showing off signs of distress, even though we've seen dramatic moves. I mean, if you would have told me 4 months ago we were going to go from 15,000 to 60,000 in Bitcoin, I would have thought some of these Bitcoin lending firms the big ones would have had big problems. I haven't seen any signs of that, which is very, very positive. That means that the risk controls at these places is probably a lot better than I thought it was, and that's very encouraging.
That's great. Turning to the equity markets, and their trends. What behaviors do you see in the stock markets headed into the short and medium terms, and what impact do you see on crypto?
I mean, equities are just a different game than I'm used to from a interest rate perspective. But at this particular moment, I've been pretty bullish for a while. I mean, I'd love to find a post. I wrote a post on like about April 12th when stocks were down 35%. And I knew the Fed was coming. I mean, they were coming because they said they were coming. When they say they're coming, they're coming. And I was like, I wouldn't bet against America. I just wouldn't do it. And I mean, good Lord, I wish I borrowed money to invest in the stock market because it's just gone straight. But I'm still as optimistic today as I was almost a year ago. Look at the core conditions. What do you see? Okay, you see stocks at all-time highs, notable. Rates very close to all-time lows. I mean, we're still only 30 basis points from all-time lows, except for coronavirus. It's the cheapest cash ever. You've got, stocks at all-time highs. Well, some relative form of global peace. I mean, I know there's problems in the world, but Goldman thinks the unemployment rate is going to go to 4.2% by the end of the year. That's extremely encouraging. And the most important thing is, well, three more things. One, coronavirus numbers are coming down. Shots are going up. So the pandemic is sliding behind us a little bit, or maybe a lot of it. But also we have a very benevolent Federal Reserve who's been committed since Lehman and now again. And finally, you have Congress doing something. I mean, for years, the criticism, and it's been accurate, is that where has Congress been? They haven't done anything, regardless of administration. Whether it was Obama, whether it was Trump, the fiscal policy didn't exist. And suddenly, since coronavirus, it's like, it's insane. And now we're passing $1 trillion like it's going out of style. So you have all these forces at work. Strong fiscal policy, strong monetary policy, an economy that's clearly improving very, very rapidly. It's hard not to be bullish on stocks, But again, markets look what the markets were pricing in April is what we're seeing today. I don't know what the markets see in December exactly. I just don't know. But I mean, right now, I don't know what the imbalances are that are going to throw us off course. In 9 months, we'll know. Maybe there'll be a conflict in Asia. Maybe inflation will really take off. I don't know. Maybe rates will go to 4% in the 10-year yield. Maybe the Fed will tighten. Okay, fine. If you look, if those things happen this summer, well, I'll tell you what, the stock market's going to get hammered. So, I can only go off the information in front of me, and the information in front of me right now is pretty positive, I'd have to say, all things being equal. So, but as for Bitcoin, it's hard to say. I mean, people are so convenient in how they do their analysis, and so they'll look at 3 months of data, and then they'll look at 10 years, and they'll look at 3 minutes, and so it's. I mean, right now it does feel like Bitcoin is trading like a big tech stock, and I don't know if that's a good thing or a bad thing. If the tech stocks tank this year, will there be a flight to quality in Bitcoin? Maybe. I don't know. I mean, I don't see it as a tech stock. I see it as a currency. So, we'll see. I mean, look, as you know, Jamil, the corrections in Bitcoin are always bigger than people ever thought possible. So I don't know. Could we trade back down to 12,000? Sure, why not? I mean, I would never tell you that it can't happen. Anything can happen. I'd say it's a low probability event, but it's not zero. It's just not. I mean, because I know how markets work. And when pain gets handed out, it accelerates, right? So if we trade below 30,000 or 20,000, that's where the real pain starts. There's not pain at 48,000. There's not pain at 42,000. There's pain as we get to 21,000 and 19,000 and 15,000. That's where people capitulate. So, and I don't know, I'm just making these numbers up, but clearly we've seen now 4 or 5 times a move down to 40,000 or 35,000 doesn't faze people. So people don't get scared, and so, so at least not yet. And so, that means that we could see a wide range here. And we could trade between 30 and 60,000 for months. I don't know. It's possible. Yeah.
In the last bull market, which was 2017 going into 18, Bitcoin fell back 30% or higher 8 times. And that's just what it does in a bull market, and it goes right back up. So on the way up, it goes down, and that's just the natural behavior.
That's right. I mean, I got involved, my timing could not possibly have been worse, but I got involved literally near the high at 20,000 for the first time ever, and started to buy some, and, exhibited pretty good discipline. I mean, I don't think buying something that's going straight down is very sensible, but unless you are comfortable with a complete loss of that dollar amount. But I mean, it traded down to 3,000. It was an 85% pullback. And so I literally, and I fortunately, I just said by about 8,000, I said, that's it. I'm not buying anymore. And I didn't get out, but I mean, so an 85% pullback from 60,000. I mean, I know it's like 56, but let's just, for the sake of math, that would be about a 50, go back down about 10,000 or so. I don't know. I mean, I'm not going to tell you it can't happen. I've seen it happen. It happened to me. So it can happen to me once, it can happen to me twice, and it can happen to anybody. But I don't think people in the streets of Lagos cared.
My next question is this. Your company in Inveniam builds tools that facilitate digitization of private markets. What are some of these tools, and what could be the broader blockchain benefit from your tools and inventions?
Well, it's been a fascinating ride in the year that I've been with Inveniam, and I've learned a ton. Where we're seeing the greatest adoption for what we're doing is fund administrators in particular. I mean, there's adoption and commercial real estate, but let's just talk about fund administrators for a moment. So these are, could be custodians or, organizations that could, have assets on their balance sheet from large clients. In particular, what the clients are asking for is they're saying, we would love an independent third-party mark on the assets that we have at a place like Fidelity or Bank of New York. I mean, those are the types of Northern Trust, those types of organizations. And so these types of, fund administrators, and I'm just throwing out just, general names, but you might have a situation where a large fund administrator has a client that's a Stanford University might be a client, and they say, look, we got $400 million invested into a private equity fund of yours. We would love an independent third-party mark on that so we can go sell off a tranche of it, borrow against it, whatever we need to do. What's interesting, what's very interesting to me is the fact that these fund administrators that are large, very sophisticated financial firms are coming to us and saying, we need your solution because we don't have it ourselves internally. And it's the classic buy versus build. We can either go build it on our own or just buy it or, lease it from you or whatever the case may be. And I think, and I'm just watching this and I'm thinking, wow, we're talking about tens of trillions, maybe hundreds of trillions of dollars in assets. And the fact of the matter is the fund administrators are coming to us and saying, we need your solution. So let's onboard with you. Let's put this in the market. Let's do this. And so it's just, it's fascinating. I don't know how else to say it. It's flattering, and we have a lot happening. And same with commercial real estate. You have these extremely large owners of portfolios and, billions and billions of dollars. They don't really know what their assets are worth in a lot of cases. They really don't. They know what that's worth when they sell it. Okay, that's fine. So, but let me give you a specific example, Jamil, because I know correct me if I'm wrong. You were at AIG for a while, I believe, and senior positions are correct. Is that right? Yeah. So AIG was once the biggest insurance company in the world, I believe.
Yes, at one point, yes.
Right. So you understand it better than I'll ever understand it. There's a concept in accounting called there's level 3 assets, level 2 assets, and level 1 assets. And a level 3 asset is it a liquid asset, and in a liquid asset's inherently that they're hard to get a price on. Through the use of our software, we can move assets from level 3 to level 2. Level 2 is a marketable security. It's like owning a stock. If we don't move it because we're not an accounting firm, but we're partnered with Deloitte. Deloitte will look at the observable inputs. That's the key term, observable inputs. If we have the proper observable inputs to show a client, client has the data, we show it, we permission it to Deloitte. They say, that's great. We can now move this asset from level 3 to level 2. Now the client can go borrow against that at more favorable terms. It's that simple. So they're looking at this and saying, this is huge. We're happy to license your software and pay you for the use of your software and the valuation as a service and your solutions team, which is like our army of consultants. But because the sizzle for the client is we just got moved from level 3 to level 2. Our borrowing costs are going to go from 4.5% to 2.75 on a $100 million asset recurring annually. We just saved $2 million, or whatever, pick a number, $20 million, that we're going to save because we're more up to, we're where we need to be in accounting, from an accounting framework. And so that's what's beautiful about it. And it's key that we collect the data. Let me go back. We organize the data for the clients. They keep the data under their control. We don't touch the data. So we don't take in the data. The client keeps it and then they permission it out as necessary. So, but anyway, the net win for the client is typically a better accounting treatment or more timely marks on their assets that give them greater flexibility with, borrowing against it or whatever they want to do. That's what Inveniam does. In 30,000 feet.
No, that's awesome.
Yeah.
Thank you.
In just to add one thing, and I know AG is so big, but for insurance companies, we can move assets on a balance sheet from Schedule BA to Schedule A.
Right.
For regulated insurance companies, this can cut the reserve requirements by 50%. It's huge. It's just huge. So they have a capital requirement of X, but if we can move it on the balance sheet from Schedule BA to Schedule A, they can cut that capital requirement by 50%. They can kick out capital to shareholders. They can make other investments. They can, this is enormous to insurance companies, enormous to their balance sheet flexibility. So anyway, there's just a lot happening, and that's why we're in the process of completing our Series A. and we're bringing in some extremely exciting and well-known partners, strategic partners. It's been fascinating to see, because there's been far more understanding of what we're doing from strategic investors that need our product. We've talked to a lot of VCs, and it's been interesting conversations. They're just different, because the strategic investors understand exactly what we do, where the VCs just ask different questions. But anyway, it's all good. I mean, we've had greater buy-in from strategic investors. I don't know how else to put it, and that's fine, because those are ultimately the partners you really want to have going forward. But anyway, it's a dynamic mix of, our cap tables. Pretty dynamic, and we'll be able to talk about that more publicly in a few weeks.
Sounds exciting to me. If we had that, if I had known that about AIG, we'd probably be a bigger company right now. So than they are.
I mean, our phones are ringing. People are calling us. I mean, when I say people, I mean large institutions, and so, I mean, again, this has been kind of a fun story. And obviously, you and I met on LinkedIn. That's how I met Pat O'Meara, was on LinkedIn. My friend David Lafredo now works for Inveniam. His background was Ernst & Young, worked at Accenture as a consultant, ran Bloomberg's trade book. He was COO, reported to Mike Bloomberg for 7 years. And he's just managed big fintech projects and big teams for years, And, as he got familiar with what we were doing at Inveniam, he talked to our CEO, Pat O'Meara, and said, you should think about having your own solutions team. Because we were talking about, like, bringing in outside consultants when we needed to. And he's like, that's crazy. Why would you do that? I mean, you're going to have so much work. Why would you go hire a bunch of Accenture? I mean, it's going to be so much more expensive. Just build your own solutions team. And then Pat's like, great idea. You're hired. You figure it out. And so, but now we're talking to, just gigantic. We're talking to like the biggest landowner in the Middle East by far. It might be the biggest landowner in the world. I don't even know. And so they want to onboard a great number of their holdings because they don't have accurate pricing on it. So that's a big project. We're gonna be hiring a lot. We're gonna need a lot of consultants to come in to do that work. And so that's just terribly exciting. Like anything else, I mean, it'll get incredibly more streamlined as we grow. The software's only been in the market for a year. We've been in a pandemic, for crying out loud, but I mean, the number of assets we onboard will go sharply higher in the next 6 to 12 months, 24 months, as the software is adopted and we have more clients, so forth and so on.
Great. So one last thing, I want to shift gears a little bit, and back to the crypto economy and back to banks. Actually, one of my golden crypto rules for newcomers to crypto is don't believe any crypto research report written by a traditional bank. Recently, Citibank created a 108-page report about Bitcoin entitled "Bitcoin at the Tipping Point." What is your opinion about some of their arguments? And isn't it banks and not Bitcoin that's actually at the tipping point themselves?
I don't know about that. I mean, the last part. No, I mean, yeah, I think banks will get disrupted, but they're not going to go away. They won't go away. I mean, the Fed needs them to be a conduit between the Fed and the markets, and so they'll be there they'll change. And clearly, there's been a lot of the banks are making more money than ever, and they're laying people off left and right. I mean, because they're being disrupted through payment companies like Stripe and Square and PayPal, and so there's SoFi. I mean, there's disruptions happening. It's not just Bitcoin; it's disrupting banks. Believe me, and that. I mean, there's all these fintech companies that are just astonishingly just filled with talent, and and so anyway, but Bitcoin's a big part of the narrative, but it's not the only part. As for the research, I mean, I was a kind of a mediocre student my whole life, because for the reason that I never really would finish reading the entire book or I was a big Cliff Notes guy and just kind of sift through things. I never take anything too seriously. Like I make my own decisions, but I like to have a wide array of inputs just for me. So I'll read almost anything, whether it's a bank report, whether it's some person on Twitter, just I'll read obviously traditional news. I definitely read the Wall Street Journal, New York Times, CNBC, Financial Times, Bloomberg, every day. So, I mean, it's a mix, so I've got mainstream media, I've got bank reports, I've got other industry news and followers, and, and it just kind of, and I never take anybody too seriously. I mean, if there was one single, like I really pay close attention, there's the, people talk about the Mount Rushmore of athletes. I have my Mount Rushmore of hedge fund managers, okay? And I thought about this. And in my mind, it's Ray Dalio, Ken Griffin, Jeffrey Gundlach, and David Tepper, and some others that would be close to that, very close to they're in the conversation with those four. And when those four speak about markets, I stop what I'm doing and listen very intently, because I want to know what those guys think, because they're all spectacular. They've made so much money, and they've made the money because they're brilliant businessmen, but because their knowledge of markets is certainly better than mine. And so those are people, when they speak about, and interestingly enough, all four of those guys have had very little to say about Bitcoin. Ken Griffin has nothing to say on it. Dalio and Gundlach have been pretty vocal recently, increasingly so. And I've never heard David Tepper say anything about Bitcoin. But anyway, for Citi, look, 3 years ago, the banks were laughing at Bitcoin. Now they're doing 100-page reports. I mean, to me, that's progress.
Right.
Every bank on Wall Street's talking about Bitcoin all the time now. I don't know. It's validation is what it really is. And so that's good.
Great. Thank you. So one final question is this. I want to first of all, thank you for your time today.
Yep.
It's been an honor and a privilege to not only have this call, but in the last few years, I've been able to comment on your post on LinkedIn, and that's helped me with my intellectual curiosity and to learn and grow as a professional. So thank you. Is there any how can our listeners reach out to you? How can they contact you? How can they learn more information about you?
Oh, absolutely. I mean, probably the easiest way is to just go on LinkedIn and send me an invite. I mean, I'd be happy to accept it. It's funny, but it's also kind of embarrassing. When I started as a heavy user on LinkedIn about 4 years ago, you could send invitations. I could invite anybody I wanted. So I just click. I invited all these people, and eventually you get cut off. So I can't send invites out. But people can invite me, then I can accept it. But please reach out to me on LinkedIn. I literally accept every invitation that is sent to me, and add people into my network. And then, they can just email me on LinkedIn, and I'd be happy to get to know more people, and love to tell people about Inveniam, but also to like to hear what people are working on themselves. I've been, it's just sort of a hobby. I mean, I've tried to make introductions to people to advance their careers or the business interests when I can. I mean, I've got a full-time job and family, but I'm more than happy to make introductions to people whenever I can, just because I think it's the right thing to do. I mean, that's, the trading world is very dog eat dog, and it's very contentious. And I think now that I'm in a fintech company, it's a different culture, and you get further in life by helping other people than just looking out for yourself. And I've had plenty of people that have done great things for me as well. So I try to return the favor as much as I can.
Great. Thank you very much.